Welcome back. This is part 2, a quick follow-up at the crude oil chart, and this is going to be with a 1-minute chart. Now, the thing I want to show you here is what we call a 60-second stop, and I utilize this for any economic release because the first 60 seconds of an economic release don't necessarily show us the overall trend of the market, and it's typically going to be an error to go with that initially. In fact, in the first video, part 1 of this crude oil discussion, talked about how the actual trigger long didn't happen until about an hour later. Okay, and prices actually pulled back almost all the way to 78.50. So taking a look, and we're going to examine the actual release candle. This is now a 1-minute chart, and this yellow line now is actually on top of the 10:30 candle. Let me slide this over here. So that's the 10:30 candle. And over the course of 1 minute, utilizing what we call, again, a 60-second stop, we can see we launched from an open at 10:30 of 78.86. And keep in mind, this is still working from the notion of shorting 78.75, the double top, and determining whether that short was still valid during all the chaos and volatility of that inventory number. So within that 1 minute, we went from the open of 78.76, the low was 78.78, the high was 79.29, but we pulled all the way back to 79.06. Now, we talked about the different points of validity. Now, there's never a single stop loss. What you always have to ask yourself is, where is the trade no longer valid? Some traders will have a much wider definition, much more wiggle built into the validity of a trade, while some will be much more conservative, keeping a tighter price as a validity level. So there's two things you could have done here, working from the same levels we talked about on that 5-minute chart in part 1. The 79.00 level, so 79 plus 5, and you can see there's 3 lines here. The first lowest line is 79, the second one up is 79.05, and the third highest is 79.20. 79 is not a good place to put the stop loss because that is going to be where the resistance should come in. You can go up as high as 79.05. We just missed that by a penny on the close because we closed again at 79.06. You get an idea of how much pressure there was. Now, the furthest away in terms of wiggle room that we talked about would have been 79.20. Anything above this really does push the validity of a 78.75 short. So somewhere between 79.05 and 79.20 would be where your wiggle room would be. The validity would be no higher than 79.20 and really probably no lower than 79.05. So if you were conservative, keeping that tight stop, you would have been, after 1 minute, stopped out because the close was 79.06. And at that point, you probably would have said, okay, let's go ahead and call it a day. The reason and let's talk about the methodology of that 1 minute stop here. 1 minute stop literally means you're counting down 60 seconds. I call it a 60-second stop for a reason. It's a time-based stop. It's not a price-based stop. It's giving the market 1 minute to simmer down, not getting caught up in the emotional, psychological frenzy. After 60 seconds, on the 61st second, you ask yourself this question and this question only. Is the trade still valid? Now, that is determined by the price at which you have determined the point of validity is. If you determine 79.05, with a 79.06 close, that's not a huge reason to panic. However, prices still had a lot of volatility in them, and if your price was 79.05, that's a very good reason to go ahead and call it a day and get out of the short. Now remember, we're talking about a short here because we're not even discussing a breakout because that wasn't even valid until an hour from where we are right now. Okay, and let me rewind this chart so we can get a clearer idea. I'm still discussing this yellow line here, this yellow 10:30 release, but let's kind of do this with a little less distraction, and we'll go right to the candle we would have been looking at live. So let me get back over there. Just bear with me here. Okay, so the very next candle, this is 1031, this red candle. If you were a 79.20 validity, in other words, you're willing to give the market a little bit more wiggle in the face of this very huge economic release, your short would still be valid, and carrying that through one minute candle at a time, as this thing went down lower, you would have been actually at some point in the money with that 60-second stop, letting the market simmer down. Again, that was with a 79.20 validity point. Is one right or one wrong? Again, there is no right or wrong here. It's where you believe the validity of the trade is. And again, I would go no higher than 79.20, utilizing that minor psychological level of the 20 tick, the 20-cent level. No higher than that, but no closer than 79.05. Price got me in, price will get me out. Not a dollar decision, okay? In fact, once we gave the market a minute to simmer down, come off that boil, so to speak, a crazy overboil there, that psychological frenzy, we noticed that the overall direction of the market was actually sideways to down for about an hour. Again, the long did not trigger until 11:30, 11:35. And if you want to review the part one, you can see that. But what I wanted to do here is show you the decision you make using that 60-second stop, and also how we sort of micromanage the two validities. Neither one is correct. If you are a more conservative trader, 79.05 is perfect, and you got out. And that's the right thing to do if that's what your risk tolerance is. If you're one of those traders that doesn't mind giving something like the crude oil market at the inventory release a little bit more wiggle, 79.20. No higher than 79.20, no lower than 79.05. Okay? And that's how we micromanage during this 60-second stop, a time-based stop. Okay? Two options here was one getting stopped out, the other one taking a very tiny shot at maybe 20 to 25 cents of profit here off that 78.75 double top. Okay, so again, two-part video. If you want to watch the first part again about how we would have determined getting stopped out, and then where the actual long trigger occurred about an hour later, and here what we do at the actual release using the 1-minute chart.